Good day, everyone. This is Ulisani Magia speaking. I'd like to welcome you to Lesson 16, Interpreting Financial Results, Part A, where we're going to be focusing on the income statement. This is now Chapter 4, Interpreting Financial Results. So, on our previous lesson, we did Lesson 15, which was Chapter 3, which was Statistical Data Analysis, which was the chapter name was Basic Statistic Calculation. So where we mostly talked about data analysis, or we learned more about data analysis. So under this lesson, we'll be focusing on the income statement, understanding the line items of the income statement, and what information needs to be included within specific categories within the income statement. So all of this is on our textbook, Finance in Media, 4th edition, page 187 to 200. And some of the most important tools to understand or information to understand have been listed within the following videos. The difference between gross profit and net profit, which was part of your first assessment. Understanding the income statement. So here this video explained more about the income statement, mostly not just only the one related to media, but the overall income statement. So it is important that you always attend your class regularly, you always perform or participate in class during class activities, as well as discussion during the class. Make sure that you complete the textbook activities covered in this lesson. So what we are going to learn today is that we will be able to define statement of profit and loss and other comprehensive income, explain the difference between the gross profit, net profit, and cash on hand, explain the causes of increase and decrease in the income and expenses, identify and demonstrate the way to reduce cost or expenses of the business. So all of this, by the end of the lesson, we should be able to do everything that is listed here. And the lesson outline also follow the same lesson outcomes which have been listed here. So we'll start with explaining the comprehensive income statement, and then later on we start with the line item, which will now give us the difference between the gross profit and net profit, and later on talk about the importance of reducing the expenses. How can we reduce this kind of expenses? So here it says that an income statement is a financial statement that shows the company's income and expenditures. So in addition to that, this income statement also shows the profitability of the company given for a specific given period. It shows whether this company is going to make profit or the company have made profit. So income statement can be used as we can do a projection income statement, and we can actually have an actual income statement which will be showing the actual result of the company. So we prepare two types of statement, the projected income statement as well as the actual income statement, and later on we get to compare the two to see if we actually manage to achieve what we plan to do. So the income statement also indicate if the company is being profitable or not. So here it says that it shows whether a company is making profit or loss for a given period. The profit or loss is determined by taking all revenue and subtracting all the expenses from both operating and non-operating activities. So when we calculate the income under the statement of profit or loss and other comprehensive income, we have to add all the revenue and make sure that we subtract all the expenses that the company incurred trying to generate all this revenue. So all of them have to be included or shown within the income statement. So here it says that the income statement along with the balance sheet or cash flow statement helps you understand the financial health of any business or your business. So the income statement is also known as the profit or loss statement, or the statement of operation, or the statement of financial results or income or earnings statement. So these are all other types of terminology that can be used to describe the income statement. So the importance of the income statement is that it helps you to be able to identify whether you need to be able to generate more profit by increasing revenue or decreasing cost, or you actually have to apply both of them at the same time. So this is some of the importance that the income statement can help you with within your business. It also shows you the effectiveness of the strategy that is being set by the company at the beginning of the financial period to say this current strategy is actually paying off or it's not paying off. It needs to be changed. So the income statement gives us more detail about the strategy that the company is actually using. If we are overpricing the product to actually generate more revenue, the income statement will reflect whether this overpriced of product is actually worth it in terms of the company. Is it being effective? If more people are actually buying, thinking that this is a quality product because of the price, or we're actually losing customer because the product is overpriced and customer do not want to pay. So this will just indicate that type of effectiveness of the strategy that the management have actually taken. So here it says that the business owner can refer to this document to see if the strategy have paid off. So these are some of the importance of the income statement. So they continue on this side saying that following are the few other things that an income statement can inform us, which are the importance of the income statement. The frequent reporting. So while other financial statements are published annually, the income statement is generated either on a daily basis, monthly basis, weekly basis, quarterly or monthly basis. And due to this, the business owner and investor can track the performance of the business closely and make informed decision. So it allows us to be able to see at an early stage whether the strategy that we have decided is going to pay off because of the frequent reporting. And then it also pinpoint expenses. So the statement highlights the future expense or any unexpected expenditure which can incur or which are incurred by the company, and any areas which are over or under budgeted. So the expenses include building rent, salaries, and the other overheads that are involved in the operation of the business and the overall analysis of the company. So the income statement is important because it also gives a full indication in terms of whether this company is making a lot of profit, and if you invest into it you will actually get something in return. So when you take a look at all past history income statement of the company, it will give you an indication in terms of the profitability and the payout ratio to say that this company, when it comes to dividends, it pay out a certain ratio of the profit. And all of this can only be done or seen through the income statement. So investors such as bank and other financial institution, they can also analyze this document to decide whether the business is loan worthy by taking a look in terms of how much profit it makes and how much of debt we can give it based on its profit, to say that these are the type of capital and interest this company can be able to pay us based on the profit that it actually have, and after analyzing all the expenses that the company have. So this is to make sure that the company does not become overwhelmed by the debt that the financial institution will actually give to the company. So they assess the income statement to be able to see how healthy is this business, and if we give it a loan, will it be able to pay us back and without having any difficulties on its operation. So they also get to use what you call the income statement. So some of the line items within the income statements that are found within the nominal account section of your trial balance include your sales, cost of sales, gross profit, operating expense, interest, net profit, dividends, and retained income. So most of the time after the gross operating profit, sometimes we have operating incomes, which I'm gonna explain at a later stage, which is currently missing within our income statement. So the first line item, let's talk about the sales and sales revenue. So when we refer to the terminology revenue, so revenue can either be the sales or either be the revenue, the services rendered. So revenue is the income that is generated by the business through conducting its core primary activities. So when we say core primary activities, it means that if the business is in dealings of actually selling product, so meaning that when we talk about its revenue will be all the income generated through selling those products. And then again, some companies have got different streams of generating revenue. So where they either sell product, when they sell product, we're gonna have sales revenue. When they render services to their client, we're gonna have sales rendered revenue. And then if the company also have got advertising space where they give people space to advertise on their own platforms, then we're gonna refer that as advertising revenue. So revenue is a general term that generalize all the types of income that the company have. And then we have got sales. So under this lesson, we're going to focus on two types of revenue: the sales revenue as well with the services rendered. So here it says that this is the first line item in the income statement, and it gives you a summary of gross. It gives a summary of gross items sold or services rendered by the company. So every business aims to make sure that the sale is maximized as much as possible so that it can generate a higher profit. And for you to be able to calculate the sales, if we are talking about selling of products, so it will be the number of products sold multiplied by the selling price. And if we're talking about services rendered, so it will be the services rendered multiplied by the services fee charged. So the fee charged will include all the call out fee if you go out to perform a specific job, and then you're also gonna charge for all the material that you will use to conduct that service, and then also that you're going to charge your labor, which is for you being able to perform the job. So that's the service fee is what it will include, and you'll multiply this by the services rendered. If you say that for every service that I render I will charge 1.5, so meaning that if you render that one service you're going to charge the client 1.5. If you render the service twice to the same customer, you're going to charge that customer 3000, which is 1.5 multiplied by 2. And then one of the most important thing is that the method to maximize sales is that you need to ensure that the service or the product that you are selling is of high quality. So in some instance, you find that some companies actually do render service and also sell product at the same time. So meaning that their stream of generating revenue is both from services and selling of product. So therefore, for them to maximize their revenue, therefore they will need to make sure that their service and product are of high quality. So here it says that ensure your services and product are kept up to date with latest trends, fashion, and technology so that your customers always look for your product. And then advertise your product to the right target. If your product is related to people who love fashion, so make sure that you show this through social medias because that's where those people are looking for new trends in terms of fashion. Then if your product is related to engineering, so therefore make sure that when it comes to car magazine, engineering magazine, your product is advertised there because that's where those people interest are at. So and then again offer discounts to increase sales. So if you have got customer that always buys in bulk, so you can actually get to give them or offer them discount to so that they can always come back to you and buy from you to show that you appreciate them coming to you to buy their product instead of going to others. And one of the most important thing is that avoid selling products that are broken because this will actually maximize your sales return, meaning that now your sales will actually be low. So here it says that an example of sales will be money received for advertising space, money generated from broadcasting shows, money received from actually selling a product. So this will be types of sales revenue or revenue generated by the company. And then now we have got cost of sales. So cost of sales is an expense, but it is not just an ordinary expense. It is an expense that we actually incur as conducting the primary core activity of the business, which is actually selling product. If your company sells product, then you're gonna have cost of sales, which is as the part of performing the primary objective of the business, which is selling the product. So the cost of sales, before we calculate, we subtract any other expense, we're gonna first calculate the gross profit by going and say your sales minus what? Your cost of sales, which is generated through selling of your product. So the cost of sales here says that this is the cost incurred by the business to generate sales revenue. So your operating expenses, the reason cost of sales do not form part of operating expenses is because operating expenses, they are there to assist you to actually sell the product, which once you sell the product, you get to receive cost of sales. So this is how cost of sales gets to be generated. So for cost of sales to be generated, you first need to have stock or inventory. So once you have got stock or inventory, you are going to buy stock or purchase stock. So once you have it, we call it purchases of inventory. So until that product gets to be sold, that's when we're going to transfer that cost of purchase to become what? Cost of goods sold. To say that if you buy 20 items, 20 cell phones, each cell phone is costing 100 Rand. You went and sold 5. So meaning that the cost of sales will be the 5 cell phone multiplied by 100 Rand. So that will be 500. So that will be the cost of you having those cell phone and selling them. So for you to sell those cell phones, the cost that you incurred was 500 for those 5 phones. And then the other ones that are remaining, the 15, will still remain as cost of purchase because they have not yet been sold. They become cost of sales once the goods is sold. Same applies to cost of services rendered. So meaning that you only gonna incur cost for to render the service once the service have been rendered. So in terms of a manufacturer of a product, here it says that this include both the direct and indirect cost in the process of manufacturing the product, such as your material cost, your labor cost, your machine usage cost, your inspection cost, your assembly cost. So all of this will form the cost of production. And from once the product is sold, we turn the cost of production to cost of sales to say that this is the cost we incurred for us to actually get to sell this product. So the cost of production becomes the cost of goods sold. And to maximize the sales revenue, we need to make sure that the cost of sales is at minimum as possible. So meaning that under this one, when we go and buy our stock or inventories or material, we need to make sure that we actually look for a cheaper supplier supplying the same quality but at an affordable price. Try to reduce transportation cost, meaning that when you sell your product, instead of supplying one product at a time, supply all the product to the customer in bulk once the sales have all been conducted, all of them, well, they've been combined together, and then make the delivery. Because if you make one delivery at a time, you're going to incur a lot of transportation cost. So those are the some of the ways to reduce what? The cost of sales. And then now we come to gross profit. So gross profit. So with the gross profit here, it is defined as the net sales revenue minus the total cost of sales in your business. So this is the definition of gross profit. So most of you during your assessment, you manage to fail to actually get to answer this part where you are just only supposed to say that gross profit is the net sales revenue minus my cost of sales. That was just the mark that you actually were given to you, but majority of you managed to fail to answer this, but you managed to get the net profit. So most of you were saying that gross profit was before deduction. It is profit before deduction, which will never have profit before deduction. All our profit are after deduction, but the gross profit is the profit after deduction of only cost of sales before the operating expenses. So here it says that net sale, it is the amount of money you brought in for the goods sold or services rendered, while the cost of sale, it is the money you spend to buy or produce those goods, or the cost spent when rendering those services. So here it says that gross profit is the profit that your business have generated before deduction of operating expenses such as your normal expenses such as building, rental, water and electricity, salaries and wages, telephone bills and insurance fees. So this is your gross profit. So this is what gross profit entails. So gross profit gives us an indication to say that the revenue that we generated, so it just indicates the contribution of cost of sales towards the revenue generated, to say that this is how much profit we have made through the generation of revenue by usage of cost of sales. So that will be the profit that we actually get to receive. So here we've got a class activity which asks us to say that below are financial results of a competing firm. Use the information provided to answer the question below. So the question says that required, calculate the three firm gross profit excluding the discount received. The second question says calculate the gross profit of three firms taking into account the discount received. So the steps that can be followed here, we've got different types of steps that you can use to get to the gross profit. So if you take a look at this scenario, we've got business A, B, and C. We are comparing the three business. So for us to be able to identify which business is actually making more profit, we can just do that by just looking in terms of the number. So if we check the selling price here, it's very low, this one is very high, and this one is the second high. In terms of the cost, this one is very low, high, and second high. And then in terms of number of units being sold, you will notice that this one have got the highest unit, but in terms of its selling price it is very low. So we can actually just determine by just looking at that. So we need more detailed information for us to be able to tell which company is generating more profit through the gross profit. So the gross profit will just give us indication to say that based on the contribution of cost of sales, this is how much profit these companies are actually making. So this is what this statement or these activities actually get us to look into. So based on this, to calculate the gross profit, I'm going to explain two ways. The first way is to go and say selling price minus the cost per unit. This will give us gross profit per unit. So the gross profit per unit, we can actually use it to multiply it with the with the number of units sold. This will therefore give us the total gross profit of total units sold. Then the other method that we can use is to go and say our selling price multiplied by the number of units sold. This will give us the total sales. And then the second step is to go and say cost of sales will be the cost per unit of 60 rand multiplied by number of units sold, which is 10,500. And then for us to get the gross profit, we're going to say our total sales minus our total cost of sales. So for this activity, so I'm just gonna require my calculator this side with me so that we can perform the activity. So for this activity, we're gonna go and say 125 rand minus 60 rand equals to 65 rand. So this is the gross profit per unit. So we multiply this by number of units produced. This will actually give us 682,500. So I want you guys to memorize this or write this one down. Then we move to business number B. Business number B, we can perform the same. So if you decide to choose a method, stick to that method until you are done so that there is consistency within your analysis of the gross profit of the three company. Do not mix the type of method. So meaning that on the second one, we're going to go and say 150 minus 70. This will give us a gross profit per unit of 80 rand. Then multiply this by 8,500 units. This will give us 680,000. So the previous one we had 65 multiplied by 10,500. So I just want to put this in my mind. It's 682,500. The current one we've got 680,000. And then for number C, we are going to have 135 minus 65 multiplied by 9,500. So this will give us 665,000. So by just the look of the three gross profit, so this one is 682. So this one is 682,500. This one is 680. And the last one is 665. So now by just the look of this, we can actually get to go and say that business number A is the one that is generating more revenue or more gross profit. It's actually generating more gross profit because it is actually having higher number of units being sold that allows it to generate more revenue compared to other. But if we're to look at the sales revenue, so if we're to look at sales revenue, so you will see that we're going to have 125 multiplied by 10,500 units. This will give us 1,312,000, and then for company B, this will going to be 1,500 multiplied by 150, giving us 1,275,000. Company C will be 9,500 multiplied by 135. This will actually give us 1,282,500. So this allows us to see different types of sales as well. Then from there you can calculate your cost of sales for each and every company the same way, and then get to the gross profit. So to answer the second question, calculate the gross profit of the three firms taking into account the discount received. So if you receive discount, you are actually receiving it from buying or purchasing your inventory. So the best way to calculate this, there are two methods we can use. The first method is to go and say 60 Rand, which is the cost that we're actually buying one unit for, multiplied by, we remove the 5% by saying multiply by 5%, and with that 5% we subtract it from uh, the 60,000. So my method of subtracting a percentage on a full number is to go and say that this number as it is, it's a whole. So it is 100%. So if I was to remove 5% from that number, which is a whole, which is 100%, it means that I will be left with 95% of that amount. So meaning that instead of me having to go and say multiply by 5% minus 5% from the same number, I'll just go and say this multiply by 95%, which is equivalent to 0.95 in decimal. So meaning that the price will actually become 57 Rand. So meaning that the cost per unit of purchasing after discount is received, we will buy each unit for 57 Rand. Same applies to when we have got the following for business B. If we're to subtract 3%, that means that we will be having 70 Rand, and then this time we'll be buying it at 97% of that particular price because we are given a discount of 3%. So meaning that we'll be paying 67 Rand, 90 cent. And then when we apply it for business C, we're gonna go and say 65 multiplied by 96%. So meaning that under business C, we are actually going to be paying for per product 62 Rand 40 cent when we buy them. Then you can calculate the gross profit. So the sales will still remain the same. So you're just gonna say 62,400 multiplied by 9,500 and subtract it from the sale of 1,280 something or 30 something. So that's what you're gonna do under this activity. So I'm gonna leave it to you guys to actually use this activity as a practice. Make sure that you followed all the steps that I just mentioned and you will never get anything wrong. If you get to be stuck, you can be able to contact me and request an appointment. And then now we move towards operating expense. So before operating expense, we also have operating incomes. So most people get to be confused with operating income as well as other things that have to be included within operating income. So when it comes to operating income, so with operating income, what happens is that these are all the types of income that were generated as part of operating the business or as part of trying to generate revenue. Things such as not interest, things such as rental of business. If we buy a building for ourselves to be actually to use it and we don't actually get to use that building for operation, but or we use part of the building for operation and rent out half of the building to other people. So since the building is part of our operation, therefore whatever income we generate on that building becomes what we call operating income, the rental income that we're gonna receive. Then we also have got commission received. If we as a company we go and render service to someone and someone gives us more money as part of to say that your service was actually good, so we are receiving commission based on the service that we render to the customers. So we're gonna receive that extra money as commission. And then others include discount received. So discount received is the money that we didn't actually spend, we are given a discount. So to say that we receive the following discount, but instead of showing it there, we can also show it within our cost of sales. To so that instead of us buying this for 4,800, we managed to save 10,000 because we received a discount of 10,000. But if you don't actually do that, you can also put it within the operating income to so that you save this much. But it is always advisable to treat that within the cost of sales instead of treating it as an income because you didn't actually get to receive any money. You just only managed to save. And then this brings us to operating expenses. So operating expenses, those are expenses that are incurred as part of trying to generate revenue or trying to sell the product of the business. So this is how they get to be separated from the cost of sales. Cost of sales is the cost that we incur to actually sell the product, that we incur to buy the product before we sell it. And then operating expense are the expense that we incurred while we are trying to sell the product. So it's part of operating the business for us to be able to achieve the main objective of selling the product. So these are costs that are used to support the primary goal of the business, which is to sell the product or to render the service. So example of operating expense include the building, water and electricity, salaries and wages, telephone bills, and insurance fees. Sometimes the operating costs are classified as overhead cost. So there are other expenses that are not classified as operating expenses due to their nature. For example, interest. Let's start with interest instead of cost of sales. Interest paid, it's one of the business expenses, but we are not incurring it because we are trying to generate revenue. We're incurring it because we went and borrow money, and the money is the one that we use to fund the expense, other ordinary expense such as building, rental, water, and electricity. But again, the person who we got the money from, they are charging us for taking from borrowing us the money. So the interest is not part of the operation, but it is part of the expense that we incur to actually get to generate the capital that we are using for the business. So therefore, they get to be treated outside of the operating expenses. Same applies to interest income. When we are running our business, when we have got excess money, we are going to save it in the bank or fixed deposit account. So when we do that, the income that we receive, the interest income, they are not part of the business operation. We never do anything for us to earn those income except to put money in the bank account. So therefore, they can be treated as operating income because they are not a result of operation of the business. They are a result of a outside investment or towards the bank that we put money in the bank. So therefore, they will be treated outside the operating income. So they will be the last thing to be treated as income under our income statement. And then we have got different types of interest and interest income and interest expenses. So here it says that interest income, it is the profit made by the business in one of their investment, and interest expense is the cost incurred for using borrowed money. So types of interest income, we can have interest on debtors account, interest on bank balance, interest on savings account, interest on fixed investment. And types of interest expense include interest on amount due to creditors, interest on loan, interest on bank overdraft, interest on late payment on to SARS, where we're supposed to file our tax return and we don't file them on time. SARS charges a tax interest, or to say that we are owing SARS 20,000 and we do a late payment to SARS and SARS charges interest. So those will be the interest type of other interest that will fall within the interest expenses. So we also perform this activity during class, which is the interest, which is about interest. So this is an interest practical class activity. Number one says that the business has borrowed 200,000 at the bank for 2 years with interest charged at 15% of the loan amount. Interest are paid at the end of each year, so not paid. So here it's supposed to say paid. So it's supposed to say paid instead of paying. So its interests are paid at the end of each year. What is the total interest paid over 2 years if calculated based on borrowed amount? So meaning that our interest each and every year are calculated on the amount that we borrow. To say that we borrow 200,000 for 2 years, so each year they are going to calculate 15%, and that 15% becomes the interest that we're going to pay on that particular year. So the question says, what is the interest paid over the 2 year period of this loan term? So meaning that we are going to say 200 multiplied by 15%. This will give us the interest that we are paying over a year, and then we multiply by 2 to get the total interest paid over 2 years, which is going to be 60,000. So the answer for this is 60,000. Try to get 60,000 on the side. So I'm going to give you guys this as an activity to try to get 60k. Part B says you receive 15% interest for 8 months on a fixed investment of 20,000 of 2 years. Calculate the value of interest received. So here we've got a fixed investment of 20,000. The fixed investment is for 2 years, and the interest that we're gonna receive per annum is 15%. So now we need to calculate. The question says that we have received interest for 8 months. So let's calculate the value of the interest that we receive for the 8 months. So what you're gonna do is that you're gonna say 20,000 multiplied by 15%. So this will give you 3,000. So when it gives you 3,000, so in using calculator, that will be 20,000 multiplied by 15. So this will give you 3,000. So 3,000 is the interest for the whole year. Then it says that you only receive for 8 months. So meaning that that will be multiplied by 8 months divided by 12 to get the ratio of the interest that you received, which is 2,000. So it shows that you only received 2,000 as interest for the 8 months period. And then comes to the net profit. So the net profit says here that it is the amount of money your business earns after deducting all operating interest and tax over a given period to the gross profit. So to arrive to net profit, you need to have the gross profit minus all the other business expenses. So if you don't actually want to use that method, you can go and say that your net profit, it's all the income received by the company minus all the expenses incurred by the company. And then from there, we're going to calculate, you're going to have your net profit. So here it says that net profit shows whether the business is making more money or more money than what it is spending. So when investors want to invest in your company, they will refer to the net profit of the business to check whether it is worth investing in their money. So the net profit is equals to gross profit minus operating expenses, interest and tax. So I forgot to include interest here. So include comma interest and tax. And then we've got lastly the dividends and retained earning. So when people invest in a company as investors and buy ordinary share as part of generating capital, or you yourself, you start your own company. So you become the sole owner of the company because you own 100% of everything that is there within the company. So if your company have got shares, we'll say that you own 100%. So meaning that once your company makes profit and you decide to take a share of profit, so that share of profit, we refer it as dividends. So once you pay out the dividends, whatever is remaining from the profit after declaring on paying out the dividends is what we refer as retained income. So that is the money that you can reinvest in the business. So once you reinvest in the business, you can either hold the money in the bank account as part of profit of retained income at a separate account so that it doesn't get to be taxed as part of profit generated in the next period. So it will be indicated that you had a retained income of this much from the previous year. So the following year, if the company make a loss or maybe didn't make too much profit and you want to take a share of profit, you would also take a share of profit from the retained income. So the retained income, it is still the money of the business owner. He can still go and take the money, or they can still share the money if there are multiple partners. So here it says that retained dividends and retained income are last two items to be presented in the income statement of private companies. So the dividends represent the share of profit after all business expenses have been accounted for. It is calculated on the net profit of the company. Profit that is not shared by the company owner at the end is referred as retained income. So this profit can be used to expand the business or get shared in the year the business suffer a loss by the business owners. And here we've got a sample of an income statement. So this is a sample of an income statement where you have got your net sales representing your sales plus services rendered, and here you have got your cost of sales and cost of services rendered. When we subtract the two, we're gonna have our gross profit, and from gross profit we're gonna subtract the operating expenses and operating income. So these are other income earned by the company from other investment excluding interest and selling of assets. So they include selling of assets. If you sell assets, so they will have operating income. So you are selling assets which is used for operation of the business. So meaning that we're gonna include that as under operating income. And then we've got operating expense. These are the total of all expenses incurred in the financial period, excluding the cost of sales and interest expense. And then you're going to have your operating profit after the two have been added and subtracted, which the operating profit will indicate how much profit have been generated after incurring all the expenses excluding the interest and tax. Then you're gonna you're gonna add your interest income, subtract your interest expenses to get profit before tax. And then once you subtract the profit before tax, once you subtract the tax and from the profit before tax, you're going to have your net profit after tax. So this becomes the net profit after tax. So from the net profit after tax, we then can say if we made enough profit, let's declare dividends, let's take a share of profit. We're going to take a share of profit, and whatever is remaining, we'll retain it within the business and either use it to expand the business or to actually get to declare dividends next year, or it will serve for a rainy year where we can declare dividends and use it to pay out dividends. And then now the last part will be how to reduce the expense of the business. Remember, one of also the primary strategy of the business is that we minimize the expense and maximize the revenue so that the business owner can benefit from more profit. So it says that one of the business objective is to reduce expense so that profit can be more. So below are types of expense that need to be discussed. So I'm just gonna give tips of each and every to say that in terms of salaries and wages, to reduce this expense, we need to hire skilled laborers instead of semi-skilled laborers, because when we hire semi-skilled laborers they will take more to perform a job and there will be a lot of errors, and this will cost the business more money. So when we hire skilled laborers, they can perform the job very fast and limit the error of creating mistakes. So meaning that we get to spend less in terms of salaries and wages because we're gonna hire few skilled laborers to perform enough as much job as they can. And then insurance, to reduce the insurance, we look for an insurance company that is offering a lower premium, that is also covering everything that we need as part of the insurance package. Telephone bill, look for a telephone for a service provider that provide less, that provide the same quality, the same service, but at a lower fee. Water and electricity, try to use as much less as water as you can. And when it comes to electricity, buy electrical equipment that will reduce electricity consumption, that are electricity uh, what do you call them, the A-rated type of product, that when it comes to consumption of electricity they consume less and still give you the same quality as those that consume more. Rental expenses, try to rent at a space where there is less cost, or try to find ways in way to minimize this type of expense. Transportation and fuel cost, try to transport your customers product in bulk because you can minimize cost by that, this cost, instead of transporting individually customer product. Same with the legal fees, will take the same way of reducing this kind of fees, same as insurance. Try to find uh, lawyers that will still defend you for same types of problem, customers, complain claims through a lower fee. And then same comes to advertisement. So these are ways that you can try to reduce these expenses. So on your textbook, make sure that you go through some of them. So they are listed each one by one and ways in which you can actually get to reduce this expense on page 199. So page 199 on your textbook is to explain the type of an expense and other ways that you can actually reduce. Right now, I'm looking at page 199, wages and salaries. It says when a business expands its payroll, it will be increased. So it is important to reward employees in accordance with their productivity. So in absence of increased productivity, salary increase should never be more than the general level of inflation to avoid having a high salary increase. So this is what the book is telling, but it excluded the fact in terms of if you are actually manufacturing or if you're actually rendering service. Because if you are rendering a service and you hire people that are semi-skilled, they will take long to perform job, and that means that you're gonna be incurring more money. So it's better to hire skilled. So that's my explanation in terms of wages and salaries. So I think this is all in terms of our lesson 16. So our lesson 16 covered the income statement, which is chapter 4, interpreting financial results. So when we meet again next weekend, we're gonna be covering the first next lesson will be first the revision of the formative assessment, which you just wrote. Your results will also be handed out in case if they are being done moderated. And then after this lesson, we are going to continue with interpreting financial results, where we're going to talk about how to analyze financial statement, we're going to start with the income statement, followed by the statement of financial position. So this is all from me for today. Please enjoy the rest of your day and we'll meet next week.